Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome to the Greedy Trader channel. Well, I'm not exactly greedy, as most of you old watchers of the channel will testify. I have the most conservative approach to trading. It's just a nice parody idea from the Gordon Gekko mantra. There are only two kinds of traders, the greedy ones and the fearful ones.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Those of you who are new to the channel, this is where you can learn how to really trade like a professional. Every video I make is packed with real examples with before and after scenarios, so you can see that it is simply a question of sticking with the plan and not changing it because you're having an emotional meltdown. In this video, I'm going to show you how to incorporate macro analysis into your day-to-day trades to get you insanely profitable on any position you get into. It must be super frustrating to see Forex gurus telling you about top-down analysis and not ignoring the big picture, blah, 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 blah. They never show you how that is actually done step by step without boring you with Forex factory calendars and all manner of financial publications. Well, I'm not those muppets, so I will be walking you through the best way to do this using real examples. So let's dive in. Okay, so hi guys, welcome back to the channel. Alright, so today we're going to do something very interesting and that I probably haven't done enough on the channel. I'm going to be walking you guys through step by step on how you incorporate the macro picture into your trading, short term, mid-term, however it is you trade. I'm going to show you how you do that, because I'm sure time and time again people will tell you that you need to see the bigger picture. You have to focus on the long term. You can't focus on the short term. But it feels very subjective to most traders, or it just feels like it's like code or something, and it's not like a code word. It's just many people who want to talk about this are not very good at telling people how to do it. They just know that they heard somewhere someone say that the bigger picture is important, or they just happen to see a bigger move on like a longer time frame and they've concluded that it's all about the bigger picture. Well, naturally, and for those of you guys who know about market profile, naturally, of course, it's about the bigger picture. You would often see this in market profile, for example, something that we cover extensively here on the channel, and we talk about other time frame. As a market profile trader, you'll talk about the other time frame, and the other time frame are traders who can trade from advantageous positions. What does that mean? It just means they have a lot of money, and they're often able to trade from positions that the average person can't, because they have a lot of capital to be able to hold those positions. So we call them other time frame for those reasons. So those other time frame traders, they trade on longer term horizons. So a lot of the movement is going to be big when the market moves, because if you think of it in terms of these big traders have accumulated lots and lots of the asset at prices that are really cheap, or they're selling or distributing a lot of the asset at prices that are really expensive. So when the market moves, it moves in huge bounds and leaps. And when it does that, most people start to really understand that, oh, the intraday doesn't really matter in those kind of circumstances, right? So it means that a lot of the time the trader is feeling like he has absolutely no control over what he does.
I was not in control of that situation at all.
In the intraday, because at any moment these very large traders can move this market. But that's it. That's the general consensus. But if you were trading, how would you go about doing it? And that's what I'm going to show you here right now. All right, so over to the charts. Now, first, the very first thing we want to understand about macro is, what is macro? The macro picture. For me, I think it's really easy to grind down into saying the macro picture is just the big credit or liquidity events. Right, we're going to explore that. So if you look on my left hand side of my screen, you would see that I've graciously labeled out the big credit events that have taken place historically. So if I zoom out here for a second, you can see I've dealt with quite a few. Now what I'm going to do is, and there are a lot of ways you can look at macro perspective, but I'm going to focus on credit events. And I'm going to focus on credit events because on my screen I've got a chart of cable on the left, which is a normal candlestick chart, and I've got a market profile chart on the right, which are weekly profiles. Because on the left hand side it's a weekly chart, and I wanted to have a weekly profiles so you can really see the benefit of using a market profile chart versus using a candlestick chart in the same circumstances. But look at it this way, each has its benefits. In a candlestick chart, I can do this, right? I can zoom in and I can see, or rather zoom out, and I can see everything that's going on, right? So I can see a very bird's eye view, right? But then on a market profile chart, I can't particularly do that. I can do it to some degree, right? And I can achieve some effects, but I have limitations. For example, MT4 wasn't built for the profile, so there's a data issue where you can only see so many profiles over time. So if you wanted to see more, you'd have to invest in a platform like Sierra Charts, which I also have, and you might want to invest into a few other platforms, because what that would do is give you that bird's eye view, right? However, because of the data limitation, I feel it's essential to also have my candlestick chart up here so I can zoom out and get that really big picture that I'm looking for. But at the moment, I just want to talk, I don't want to talk about the profile yet, right? I just want to talk initially about the credit events. So when we think about credit events, they're like really big liquidity events, and that everything is against the dollar. So the dollar is basically the king, the daddy, and that means that all credit events would originate from some kind of dollar move. So if you think about this, right, and this is kind of test for where you guys are mentally with this, because some of you are hearing this and you don't even understand what you're hearing.
I don't have a clue what you're talking about, Phil. Not a fucking clue.
But what I'm basically trying to say is that if you are a institution and you're a bank, or maybe you're just a regular business and you need access to dollars, for example, well, your counterpart institution would probably have to go lend those dollars. So there's a huge market in the interbank for overnight borrowing, right? And there's also a huge market for longer term credit. So the entire economy, the entire system runs off the banking institution's ability to lend currency. So this could be done in terms of like swaps, for example, so currency swaps. Now if you don't know what these are, I'm not going to spend this whole video explaining currency swaps to you. Go Google, find out what a currency swap is, right? But currency swaps are some of the ways where banks can, you know, lend each other money, and other institutions that might not even be banks can get hold of money themselves, right? So the commercial banking space is responsible for creating a lot of the credit. So credit events are those events that are going to cause the big market moves, and those are the events that the larger institutions are going to be focused on. But I mean, you don't need to be a genius to work out exactly why this is the case. Well, quite simply, it's the case because the biggest institutions, for example, in the currency markets are banks and other kind of financial institutions, who they are largely responsible for creating the credit, and they're largely responsible for lending the money. So it means that they are going to have the best view of what's happening in the system and what currency they need to buy now to capitalize on, profit making any market moves, right? So that is why I focus on credit events solely, and the macro picture is largely about credit events. For those of you who followed me for a long time, you'd also know I've done some stuff around explaining the macro in terms of human behavior. So Elliott wave, for example, that's another approach to it. So you can look at it cyclically. But the most important thing whilst you're doing that is to observe that a lot of this is just credit and liquidity events. So how can we visualize that? Right, so let's go back to the charts. Right, I figured I needed to give you guys this explanation for a couple of reasons. One, you need to understand exactly what I'm talking about. Two, you know that I'm not talking crap, right? And I think this is important for where you are probably in your trading journey, is to be listening and talking to people who know what they're talking about. And I know there are a lot of people out there who have a lot of content on YouTube channels and do all kinds of things who have no clue what's going on here.
Nobody knows.
Right, but each to his own. Right, so moving on. So let's take a look at some of the historical credit events so we can start to build a picture. So first and foremost, I'm just going to zoom in. Right, so I'm going to take us all the way back. Right, it's just a very clear picture. I'm going to take us all the way back to the Fed rate hike back in 2018. Now, granted, some of you were not traders in 2018. Most people were traders from COVID, understandably, and you're going to see the exact reasons why that was the case. But a lot of people were not traders from 2018. A lot of people weren't traders from 2016, right? And a lot of people weren't traders from 2012. And during these periods, we had significant credit events. But I'm going to start with the one that I think some of the most experienced traders would have likely seen, even if they didn't know what they were doing. But if we start from there, we can sort of build a reasonable picture in terms of what is going on when these credit events happen. So first and foremost, we can see that we had a huge spike. So if we take us back to January 2018, that's when we started to get the view that there were going to be rate hikes coming in, right? So I think the Fed's first rate hike then was in March 2018, right? So Google it. But the first rate hike was March 2018. And if you look, we had the murmurs of that first rate hike in January. As is always the case, we come into a new year, start of the quarter, people expecting at the end of the quarter, when we get that Fed meeting, that we're going to get forward guidance, right? Or forward direction. So we saw that in 2018, in April, the effects of the March rate hike, right? So it took about a couple of weeks to sink in. This is very similar to what we've just seen historically with Bank of England and obviously with Fed comments and so on. When there's usually a move, the market doesn't do what you expect it to do initially. Because if we look at this, is a weekly charts, right? And that's why it's good to look at weekly charts. So again, back to that idea. And I like to call this kind of my fourth echelon of trading, right? So the macro picture is my fourth echelon of trading, right? So you guys know about my trifecta, right? So if you haven't seen those videos, go back and watch them. Volume, time, and liquidity. They're the core principles around how I trade anywhere from the short term to the midterm. Outside of that picture, I want to be able to see or develop a bias, whether that be a short bias or a long bias. And I do this from looking at the macro picture, but most importantly, observing the credit events. Right, so if we go back historically, we can see that in 2018, April, we had this big move to the downside after we had what we will typically call a liquidity hunt, right? I've heard you call different things, it's fine, but really all that's happening here is that traders are getting squeezed, right? So that liquidity hunt took place when we had a credit event, right? So that credit event was interest rate hikes. It's a credit event because the cost of credit became expensive. When interest rates change, the cost of credit becomes expensive. When interest rates go lower, the cost of credit becomes cheap. Now we were coming out of that cheap credit phase into that expensive credit phase, and this naturally triggers a liquidity event. Now what did we see was pound sterling falling as the demand for dollars rose, the US dollar's interest rate bearing. Most people would prefer to be in cash where they can get a safer return without having to, take the risk of investing in equities. So we got a credit event, and that was marked by the liquidity hunt. And then we broke down in the week, closing the week at the 140 handle. Now take stock for a second. Now we're closing the week at the 140 handle. We did a high at the time of 43.76 on cable, and then we closed 140. Right, and this all happened in the space of a week. So what the market is telling us here is that we've had a major credit event, and now traders are willing to pursue these prices lower. So from a trading point of view, now I don't have these particular bars on my profile, it's too far back, but I'm going to show you in another example what that looks like today. So stay with me, guys. So this is the point where your resilience is going to come in. I know what social media is like. You watch a little, go to the next video, you're trying to find that golden nugget, but I can assure you there is no golden nugget.
You don't quit on me! No! You keep going! You keep going! Go run!
Take the time and you listen to what I'm going to tell you over the next few minutes. Going to dramatically change the way you think about the macro picture, and who knows, it might even change the way you trade. Right? I don't know. We've got to see. But there is a very good chance that you're going to start to become very, very profitable. So it's just, again, it's up to you. If you think this is too much for you to digest, it's too boring maybe, then go check out some of those talking heads on YouTube who are doing the jig and telling you, how much thousands you're going to make in the next week, and good luck with that. But in any case, back to what I was saying. Right, so we closed the week at 140. That's telling everybody that the bigger players, so the other time frame, are planning on getting short. Now, if we were going to execute against this, we would have been able to see via market profile chart where all the bids and offers are stacked, and that would look very similar to what we're seeing here now. On the right hand side of our chart, we can see where these are late bids, or arguably, let's say these are late offers, and these are late offers, right? So these are where all the sell pressure was. There's additional sell pressure. So if this market is going to rise, it has to take out the passive offers that have moved the market lower. And we know that there were offers there because of the bulge in the profile, right? So this is how we mark out distribution and accumulation using the bell curve theory. So we know that, we can see that, it's absolutely clear. Alternatively, if you look to the upside, we also have offers stacking up. Guys, this stuff is serious. That's the point. That's why we need professional tools. You can't be going into this business, as I say, you can't be running out there naked. It is going to be hairy if that's the case, right? You need to make sure you've got clothes on your back.
I need your clothes, your boots, and your motorcycle.
And that's kind of what I'm trying to show you here. It's not a coincidence the market tapped into the offers and then sold off. If you were positioned to get long and you didn't have a profile chart, I can't see where that would have told you this was going to happen on a candlestick chart. Right? Now, there are other parts of the trifecta like volume that would have given you an idea. But again, when we start looking at the profile and we start looking at that level 2 depth, which is bids and offers, which we can see clearly on the profile, then that's a whole nother level in how we analyze our volume, right? So this is just that ability to analyze the volume. That's all that is. That's our second trifecta right there. You can see that. Right? You can absolutely see that. It's not in question or in doubt, right? So again, being able to observe this and be able to see where those critical breaks are. Like for example, we took out all the bids that were accumulated here, and that means the upside is looking weak. If these were buyers, why is this market not higher? Instead, we traded them out and then we consolidated. So any move to the upside had a very high chance of being a fake out. Right, anyway, back to where we were talking about credit events. I'm going to come to this, right? So, the profile, I'm not going to be able to teach you everything about market profile on YouTube, guys. It's just impossible for me to do. I'm not going to be able to do it, but I'm going to be able to show you as much as I can. In my 15 years trading, I'm going to be able to, more than that now, but I always say this, 15 years, I've been doing this for a lot longer. But in any case, right, in my time trading, I'm going to be able to at least show you that this is where your head should be, basically. Anyway, moving on. So you can see that was a credit event, right? So if we zoom out, we can see that we had a subsequent weekly drops into the next low, which is where you'd look to cover. So that's how you marry the macro into your shorter term view. And I'm going to show you exactly how you do that in a more step-by-step fashion. But let's move forward. So let's look at the next big credit event, right? And I'm looking at the credit events that are largely generated dollar bullishness and pushed a lot of the other currencies down. And already you'd start to notice that other currencies are losing value against the dollar continuously over a long extended period of time, in some cases before you were even born. And you've got to ask yourself, why is that the case? Well, the dollar is king, and the dollar is being treated a lot like gold as a safe haven asset. But for the long term, it's better to have dollars than to have, ringgit, or to have, shekels, or to have British pound, or to have the euro. It's just advisable to be able to hedge a lot more with dollars, and that is your safe haven, right? So again, let's look at the next big liquidity event. This was pandemic. So you can see we had a liquidity high. We pushed up. Now I can tell you, because I was very active in the market at this time, I can tell you there was a lot of information about the pandemic from June 2019. By September, October, there was already word out of China. I had it on very good account. Someone I knew out there already was telling me that there was a pandemic, right? Long before the world got to find out. Was it going to, what a lot of people took their eye out the ball was whether it was going to lead to a major credit event. A lot of people missed that, arguably. But you can clearly see, based on our second trifecta, volume on the week, right? So if you look at the volume on the week of 9th of December, there was a lot of volume trading a liquidity high and a close back in. Now, if you were slow, then the washout in January, I believe it was, December, the washout on 16th December week should have given you the idea that you needed to be short this market. That was your liquidity. And this was the pandemic, right? So that was the sense that traders knew they needed to sell assets and get into dollars because a big pandemic was coming. And they obviously understood what world governments would do and the response to that pandemic would be, because the other time frame have access to information you will never have access to. So they would have seen all the stuff that you will never see. So when we see these moves, we have to take this as a big macro picture, that the macro perspective is that we need to be long dollars. We have no idea why, right? This could be a fake pandemic or whatever, but we have no idea why we need to be long dollars. But the smart money is telling you that you need to be long USD. Are you going to go against that smart money? I don't think so. So eventually this triggered a liquidity event where we saw intervention, COVID 2020 stimulus package, right? And this is when a lot of people got into trading, because not only this credit event that was centered around the pandemic, not only did it lead to a lot of people having to lose their jobs ultimately, and in some cases, even if they didn't lose their jobs, they were able to just stay home. In developing countries, for example, people had nowhere to go. Some people were well-to-do enough that they had access to internet and they could get on the markets. And that drew a lot of people into trading, whether that was CFD brokers, prop firms, whether it was... So everything in the market today emerged out of COVID, the COVID stimmy. And it was also viable. A lot of people didn't lose money at that time because all the markets were doing was going up, right? And that was true for every market, but even truer for other markets. So whether that was Bitcoin, cryptocurrency, whether that was futures, whether that was options, anything that you traded, as long as you traded it to the long side, right, which is people's bias anyway, you were going to make money. So it drew a lot of people into trading under the possibility that they were going to make money. So that was the other credit event that led to a long side move, was the COVID stimmy. Now that's a credit event because the government physically printed money and had to lower interest rates aggressively. That made the cost of credit cheaper, or at least accessing money cheaper, not just on the monetary side, monetary policy side. It was also the same on the fiscal side, which is essentially the direct government spending into the economy. Now, again, we can see, so let's fast forward, zoom out a bit, and that pushes us to the Fed rate hikes in 2021. So this, again, you can see this was another liquidity event where the market got that first word that we were going to get a rate hike, right? When that And when the Fed stepped up, we saw the market again do a liquidity hunt and then sell off aggressively on June 2021, when I believe the rate hike actually went into motion. Now, what that would have told a lot of people is that, again, this is a credit event. We've got higher interest rates. It means the cost of credit is going to be more expensive. So we've seen on the technical side, we've seen the smart money show their hand by going to hunt stops. So they go for the liquidity and they've grabbed it and they've sold off. So again, we're going to come to the execution side. But again, you'd want to be thinking about, how do I execute into this move? Right? And that comes, the profile will become very handy very shortly. And then we see subsequent credit events. Here we don't get a liquidity hunt, we just get a continuation to the downside, but we know the credit event is huge. So the dominant position till that policy changes will be to be short, especially into these highs, looking for at least these low points, right? That will become the target reference points. Now we saw that where we had the Russian sanctions and energy crisis. Now this is not so much a credit event, but it triggered a kind of partial credit event. Why is that? Because energy prices went up. Governments had to release some degree of stimulus for their citizens. In the UK, for example, they try to give everyone money to pay their energy bills, especially people who couldn't afford it. So all of these are mini credit events that were associated probably with the pound more than other currencies. But most importantly, there was the idea that oil prices were going to rise, right? And if oil prices are going to rise, that's inadvertently a credit event, because oil price, everything's in oil. So things are going to get more expensive, and it's more than likely going to bring on a scenario where people are going to need access to money. So again, we can see a lot of people try to hedge against that. That involves governments and everybody else. They needed to borrow some money in order to stave off the coming disaster. So again, that led to another credit event where the markets kept going lower. Again, if we look here, we see a very UK related credit event, which was the bond crisis, right? So obviously that led to the Bank of England intervening in order to buy the bonds. And that effectively means that was a kind of QE, right? Asset purchasing of any kind is stimulus, right? So that QE came in, right, which was unexpected, and that caused a credit event, which eventually came to support the pound because the BOE had stepped in, and that brought confidence to investors. But again, it gave the smart money the chance to accumulate sterling really cheap, about 104. Right? It's near enough parity. And then obviously we see the market rallying. So today, here's where we are. We can see a short-term liquidity hunt. Is that accompanied by any credit events? Absolutely. We just heard the Bank of England, right? So we were on the pathway of rate hikes. So the Bank of England paused and didn't look to hike rates. But in the UK, there is stimulus in the background. So we can mark this off as a short-term type credit event associated with the Bank of England. So it doesn't matter, right? Eventually the news will come to us, right? So that's why I say when we talk about macro, we're not talking about the news. We're not talking about Forex factory calendars or data points. What we're really talking about is credit events. So someone in the financial industry or in the banking space has tipped the other time frame that they need to be short sterling, right? So here we have a short-term liquidity event and we're driving lower. Now, this brings us now to the profile. So we're going to start from here when it comes to execution, right? Because what you're seeing here is today we filled the gap in value. Yesterday, the big flurry, we can see where the bids and offers are stacked, the consolidation, which we can see here, and then we can see that first sell-off. So this is the structure break, which led to this day. So if you were trying to get short, you'd want to sell, right? And this is where the penny's going to drop, is that you'd want to sell the offer stack, which is 2704 to 2739 handle, right? So you can see that clearer, right? So you're looking at the 27 handle into 2740 as a max stretch, right? So you would want to position at the 2704. So as we touch in and then start to scale in. So first short, bit heavy, you know, just make sure that you're not too heavy so you can get washed out. That just comes into profit management or risk management. So you want to go short here, and because that's what the reflection you're getting. So you can see this push up as we're trailing this weekly candle. So if we zoom in, you can see us attacking it, but we can see where the offers are. That allows us good positioning, and that means we can easily apportion risk just above the high of the bar, knowing that we have value high to overcome and the offer stack, right? And we're looking to go short for a big run, right? And that's how you position. It's not rocket science, right? It's just you don't have the right tools, so you can't do it effectively. So let's pull this back in. Now, what are our expectations, right? Now, looking at this chart, we should be thinking about the 120 handle, right? We should also be maybe looking at potentially the 122 handle, right? As potential areas where we could see some support. But again, we will not move if our focus is the macro, right? So let's say you are a macro trader, you're not going to move on this market till you see another liquidity event. Now, we know the Bank of England did sit down, and that triggered what is likely a liquidity event, because someone in the banking space is anticipating that we're going to start to print money. Obviously, you can see that the UK is involved in various actions across the world, and this is going to be expensive. There's talk about building a military that we don't have. So you can see why the other time frame has decided to go short on the pound. And this reflects in other things that we've discussed. If you're in my Discord server, and I promise I'll leave the link below, so check it out if you want to know a little bit more about what I do. But if you look in the Discord server, I had a post up on the COT, right, the commitment of traders, and that would also give you see that there's a lot of demand for dollars on usual, but it's likely because we're coming into what potentially could be another credit event. But for now, it's led a lot of people into dollars, and no one at this point knows, beyond the wars going around the world, what is going to be the cause of that credit event. But we're going to be able to put a pin on it in a couple of weeks when some government or one of these people is going to announce that they're injecting money into the system or taking some more money out, right? Or basically continuing to starve the system, which potentially means that people are looking at the economics of this and are deciding to hedge with dollars. So we can see that that's playing out right now as we speak. So if we are going to go up at any point, then it just means we need to see another trigger that will allow us to do that. So that's how we map out the macro. We're not trying to over predict. We're not trying to do anything like that. What we're basically trying to do is just keep an open mind in terms of what the other time frame is doing, right? So you can see, using that with my market profile chart, how those executions would have worked. It is not rocket science, guys. Put it that way. It was very clear to everyone. You could have even been short from 27.50 when we had the flurry, and then we had a close below, and then we set up an offer stack. Again, this was a great offer stack to short into. We pulled up, and then we backed out. Now, how would this have looked for day traders, right? So you've seen the other time frame seems to have stepped up. You want to trade this, split your profile, right? So you can see if you're a swing trader, for example, or you're happy to carry trades overnight, this is what that would have looked like for you. You would have trailed lower for a lot of the week, and then we had this big pop up, and then we struggled ST period right here. This becomes a perfect opportunity for you to short out of a major center open, which is our time part of our trifecta, and then that would have given you a really, really big profit, right? And we can use this all on the profile. The important thing is visualizing those bids and offers and what you are seeing from them, right? We got a candlestick, helps us not be long at the top of the market, and we got our profile chart, which helps us execute into the places where the big traders are stacking orders. If you got a level 2 dome, you could probably map this out. If you got a footprint chart, you can map this out. If you use one of those book map things, you can map this out. The bottom line is, it's the tools that you have and your overall trading principle that's going to get you where you need to be. All right, guys, awesome stuff. I hope you've enjoyed the video. Till my next video, guys. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. do you think, Valentine?